Hello friends, welcome to my channel Learn with Dr. Khizer. In today's video, we are going to learn one more problem on income from capital gains. This is the part 23rd video series of this income from capital gain. So let us start problem number 13. So here the problem states that Mr. Ramanand inherited 20 acres of agricultural land in urban limits from his father during 1979. The fair market value on 1st April 2001 was Rs 38,000 per acre. He made improvements during previous year 2005-06 at a cost of Rs 3,000 per acre. Cost inflation index was 117. On 17th August 2018, he sold 10 acres of land, agricultural land, at Rs 12,50,000 per acre, and expenditure on transfer was 4%. He made the following appropriations after the sale of this land. He purchased another 10 acres of agricultural land at Rs 1,90,000 per acre. He also purchased a residential house for Rs 24 lakhs. He paid Rs 9 lakhs for a bank loan taken for private purpose. Compute taxable capital gain if the cost inflation index for 2001-2 is 100, 2005-06 is 117, and 2018-19 is 280. So here let us try to understand the problem. It's very simple problem, very interesting to learn. So this problem was asked in 2016 also. The question states that Mr. Ramanand, the assessee of our problem, he inherited 20 acres of agricultural land in urban limits from his father during 1979. His father's land was transferred to Mr. Ramanand in 1979. Okay, 20 acres of land. The fair market value of the same land as on 1st April 2001 was 38,000 per acre. So 20 acres land and 38,000 per acre of land. He made improvements in 2005-06 for 3,000 rupees per acre. Then on 17th August 2018, he sold agricultural land for 12,50,000 per acre. This is very important. This is the sale value of our question. Right? Agricultural land was sold for 12,50,000 per acre. Don't get confused with this. This is per acre, and he sold 10 acres. 10 acres into this value, if you do, you will get the total sale value. And expenditure on this was 4%. Means to sell this land of 10 acres of land, he that is 4% is spent as total transfer expense. And he made the following purchases and appropriations, that is he disbursed the amount whatever he received in this way. Okay, so let us see the problem. Mr. Ramanand is the assessee, and he is assumed to be resident because his status is not given in the question. And our previous year is 2018-19 and our assessment year is 2019-20. Right? So here let us start. The asset in the question is agricultural land. This asset is long-term capital asset, because he purchased or he got this land in the year 79 from his father, and it was there till 2018 August, because he sold the land in 2018. So agricultural land is other asset, and he hold the land for more than 3 years, so it is long-term capital asset. So long-term capital asset format will be applicable here. So it states that gross agriculture sale consideration. So what is the sale amount? 1 acre was sold for 12,50,000. He sold 10 acres. So 10 acres into 12,50,000 per acre, it will give you 1 crore 25 lakh rupees. Hope this is clear to you. Okay. Then realization expenses, as per the question, if you remember, 4% was the expenses incurred. So on this 1 crore 25 lakh, if you give 4%, you will get 5 lakh rupees. These are the realization expenses. If you minus this 2, you will arrive at net sale consideration. 1 crore 25 lakhs minus 5 lakh rupees, it is 1 crore 20 lakhs. Hope these things are clear to you. Then next comes indexed cost of acquisition. The formula for indexed cost of acquisition is cost of acquisition divided by cost inflation index of the year of acquisition multiplied by cost inflation index of the year of sale. Right? In the question, how much land was sold? 10 acres of land was sold, and per acre the land was valued in 2001 38,000 per acre. We are not going to consider for 20 acres now. What is the cost? Now, because we have sold only 10 acres, so for 10 acres, how much was the cost? So 10 acres multiplied by 38,000 per acre. So you will get the cost of acquisition as 3,80,000 divided by cost inflation index of year of acquisition. He acquired the land in 79, but in 79 we don't have the cost inflation index. Starts from 2001. So in 2001 our cost inflation index was 100. So you will write divided by 100 multiplied by cost inflation index of the year of sale. We sold a property in 2018-19. So our cost inflation index in 2018-19 is 280. So if you substitute the formula, you will get 10,64,000 as the answer. So let us see the calculation. 3,80,000 divided by 100 multiplied by 280. So 10,64,000 is the indexed cost of acquisition. So this is clear to you. Next, we should minus indexed cost of improvement. So he made improvement in the year 2005-06 at a cost of 3,000 per acre, right? So formula for indexed cost of improvement is cost of improvement divided by cost inflation index of the year of improvement multiplied by cost inflation index of the previous year. So he sold 10 acres of land. Per acre he made improvement cost of 3,000. So we will get 30,000 rupees divided by, he made the improvement in 2005-06. Here it is 5-6. So in 2005-06 our cost inflation index is 117. So divided by 117 multiplied by previous year cost inflation index is 280. So if you substitute, you will get 71,795 rupees. So 30,000 divided by 117 multiplied by 280. So 71,794.87 we are getting. So we are rounding off to 71,795. So both we got. Now to arrive at gross capital gain, we need to subtract net sale consideration with these two values. Our net sale consideration is 1,20,000 minus these two values. If you do, you will get 1,08,000. Sorry, 1 crore 8,64,205. This is our gross capital gain minus exemption. Here comes the thing what I wanted to tell in this problem. He has purchased two things. One is one more agricultural land of 10 acres he has purchased for 1,90,000 per acre, and 24 lakh rupees he has spent purchasing the residential house, and he has also cleared his due loan amount which was taken for private purpose. So this we are not going to consider because it is for private purpose, right? So this is ignorable, third point, but these 2 points will be considered for the purpose of calculating exemptions. So now what he has sold and what he has purchased. He sold agricultural land, he purchased agricultural land, right? And he sold agricultural land, he has purchased the residential house. So for this I think I need to take you people to exemptions. So let us see first exemption 54. Here the sale is residential house, purchase is residential house. This will not be applicable because we have sold agricultural land, purchase residential house. Those 54 is not applicable. Then comes to 54B, sale of agricultural land, purchase of agricultural land. This comes here, right? We have sold agricultural land and we have purchased agricultural land. So I think 54B can be applicable. So let us see all the provisions and conditions he is satisfying or not. He is an individual, yes. He has sold agricultural land, yes. The agricultural land should be either short term or long term. Yes, in our problem the agricultural land is long term in nature, and he has to purchase new agricultural land within 2 years after the date of transfer. So I think this is also done. Okay, I think we can apply this all the 4 points. Yeah, so he is an individual, yeah, and he has sold agricultural land, he has purchased agricultural land, but date is not given. We will assume that within the due date he has purchased. So 54B will be applicable here. So let us see how much is the maximum amount of exemption we need to give. Gross capital gain should be compared with cost of new agricultural land plus amount deposited in capital gain account scheme, whichever is less. Here we don't have any amount deposited information, so we will compare gross capital gain with new agricultural land. In our problem, the gross capital gain is 1,08,64,205, and our cost of new agricultural land is 1,90,000 per acre, and for 10 acres it will be 19 lakhs. So 19 lakhs is less, so our gross capital gain is more. So whichever is less we will take. So 19 lakhs we will take and finish off this. Okay, hope this is clear. Then comes the second purchase he has made is residential house he has purchased. So let us see residential house. So this is applicable 1 point. Then next is 54D. Here land or building acquired by government. So we have not sold to government land and building, we have sold the agricultural land. This is also not applicable. 54D is also ruled out. Then comes 54EC. Long-term capital asset should be sold. Yes, in our problem long-term capital asset is sold, but new bond should be purchased. We have not purchased the new bonds. We are looking for sale of agricultural land and purchase of new that is residential house. So this is also ruled out. 54EC. Then comes 54EE. Here investment should be made in the government specified assets. So this is also ruled out. We have not made such any investments. Then comes 54F. Here any long-term capital asset should be sold other than residential house. Yes, we have sold long-term capital asset, that is agricultural land, and that is not our residential house property also. So this is satisfied. And here if you see new residential house should be purchased. So any long-term capital asset and new residential house. I think this is satisfying our problem. So in that case we will see what are the conditions here. So 4 conditions is, first condition, he should be an individual. Yes, he is an individual in our question. Any long-term capital asset should be sold apart from residential house. Yes, we have sold the agricultural land, that is a long-term capital asset in our question. And new residential house should be purchased. Yes, we have purchased the new residential house. Date is not given in the question, but anyways we will assume that it was purchased within the duration, and we can apply 54F. Now what is the amount of exemption we should give? Compare cost of residential house with the net sale consideration. If the cost of residential house is more than net sale consideration, entire gross capital gain can be exempted. If the cost of new residential house is less than net sale consideration, this formula is applicable. I think in our problem the cost of new house is 24 lakhs, right? Yeah, 24 lakhs is our cost of new house, and our net sale consideration is 1 crore 20 lakhs. So if you compare here, our residential house is less, and that is net sale consideration is more. In that case we cannot give the entire gross capital gain as exempted. Okay, we have to apply the formula. What is the formula? Gross capital gain divided by net sale consideration into cost of new house. Our gross capital gain is 1 crore 8 lakhs 64,205, that we have written here. 1 crore 8 lakhs 64,205 divided by net sale consideration is 1 crore 20 lakhs, that we have written, multiplied by cost of new house is 24,000. If you substitute, you will get 21 lakhs 72,841. So this is the amount of exemption. So this is under section 54B, and here this is under section 54F. So these are the 2 exemptions. Third thing, that is he has given repaid the loan which is personal, it is not allowed for exemptions. So I think you people have understood why we have taken and how we have taken these two exemptions. Okay, 54B and 54F. So now to arrive at taxable amount of capital gain, we need to minus gross capital gain with the exemptions. 1 crore 8,64,205 minus 19 lakhs minus 21,72,841. If you do, you will get this answer of 67,91,364. Hope you people have understood this. Okay, slowly, if you have not understood anything, kindly rewind the video, see once again, okay, till you understand. Still, if you have any doubts in the problem, you can mention that in the comment section, so that I can see the comment and reply back to you with the solution. Okay, I think sufficient problems are done. 2 or 3 problems more we will do and wind up this chapter. Okay, so here 2 exemptions at same problem we have applied, 54B, 54F. Okay, so this type of problems we had not done before, so we have even covered this also. Okay, see you in the next video. If you have not yet subscribed to my channel, subscribe it so that you will get the latest notification. Okay, press the bell icon for that, and if you like this video, kindly hit the like button so that it will motivate us to that is do this type of more problems and subject oriented questions. Not only income tax, other subjects also I am going to cover in future, and even I am planning to that is bring out a series of how to write a resume, and about the interview tips, how to give a self introduction, and all those things I am going to come up in the future videos. So stay tuned with my channel. Thank you very much for watching the video.